Welcome to Today Finance at Sketching Finance. I'm James, bringing you the latest market updates and expert analysis. Let's dive in. The most powerful seat in the world is about to become vacant, and your bank account is right in the line of fire. We are witnessing a transition at the Federal Reserve that could either supercharge your investments or evaporate your savings through a new wave of inflation. As President Trump prepares to replace Jerome Powell, the question isn't just who, but how much your money will be worth by 2026. Washington has sent a clear message. They want a Fed chair who won't hesitate to slash interest rates, regardless of the inflation risk. Today, we go inside the race for the Fed's succession to see why candidates like Kevin Hassett represent a radical shift from the status quo. If you own stocks, bonds, or even just a savings account, you cannot afford to ignore this political earthquake. For years, Jerome Powell has played the role of the economic fireman, carefully using high interest rates to douse the flames of inflation. But the new era demands a different architect. Enter Kevin Hassett, the former chairman of the Council of Economic Advisors. Hassett isn't just an economist, he's an advocate for growth. While Powell looked at the past to decide the future, Hassett looks at potential, believing that tax cuts and deregulation are the real keys to a thriving America. Hassett's philosophy is simple: push the gas pedal. He believes that by lowering the cost of borrowing and cutting red tape, the U.S. can outgrow its problems. This is the perfect match for Trump's economic mandate. However, for investors, this shift means moving from a predictable, data-dependent Fed to an agenda-driven Fed. This transition marks the end of the Powell pivot and the beginning of the Hassett surge. The mandate from the White House is unmistakable: aggressive rate cuts to stimulate the economy. But there is a catch. Usually, the Fed lowers rates when the economy is cooling down. In 2026, the plan is to lower them while the engine is already running hot. This is a supply-side experiment on a global scale. The goal is to make the U.S. the most competitive place to borrow, invest, and build, even if it means flirting with higher prices at the grocery store. This aggressive stance is designed to counteract the tariffs and trade barriers being erected elsewhere. By making the dollar cheaper to borrow, the administration hopes to offset the costs of trade wars. But for you, the investor, this means the real interest rate formula, which we'll display on screen, becomes your most important tool. When nominal rates drop faster than inflation, your cash begins to lose its value in real time. Let's look at the math. The real interest rate is your nominal rate minus inflation. Under a Hassett-led Fed, we might see nominal rates at 3%, while inflation sits at 4%. That results in a negative real rate of minus 1%. In this scenario, your money in a traditional bank account is actually shrinking. This is the hidden tax of aggressive monetary stimulus, and it's why the choice of the next Fed chair is a life or death decision for your purchasing power. When real rates go negative, the market behavior changes instantly. Investors stop saving and start chasing yield. This creates massive bubbles in assets like tech stocks, real estate, and crypto. By understanding this formula, you can see why Washington is so eager for a dovish leader. It's the easiest way to stimulate short-term growth, even if the long-term bill is much higher. If you're finding value in this video, please consider subscribing. It helps me create more content like this for you. But there is a nightmare scenario: stagflation. This happens when the economy stalls, but prices keep rising. If the new Fed chair slashes rates while tariffs on Mexico or China push up the cost of goods, we could see a repeat of the 1970s. The Wall Street Journal has already warned about these inflationary pressures. If the Fed ignores these signals to satisfy political pressure, the mismatch could lead to a sudden and painful market correction. In a stagflationary environment, traditional stocks and bonds often fail. This is why we are seeing such a massive run-up in silver and gold. Silver is up 164% for a reason. Investors are voting with their feet, fleeing the potential mismanagement of the dollar and seeking refuge in hard assets. The Hassett era could be a golden age for growth, or it could be the catalyst for the return of the stagflation ghost. The Fed doesn't just rule America, it rules the world. If the US drops rates significantly below other major economies, we will see a massive capital pivot. The carry trade, where investors borrow cheap dollars to invest in higher-yielding foreign assets, will explode. This could weaken the US dollar significantly, making American exports cheaper but your overseas vacation much more expensive. As the dollar weakens, assets like Bitcoin and emerging market stocks often see a surge in demand. This is the liquidity wave that many hedge fund managers, like Scott Bessent, are watching closely. If you are a global investor, the succession at the Fed is your signal to diversify. The era of dollar dominance at any price may be shifting toward an era of dollar-competitive devaluation. Why is corporate America so excited about a new Fed chair? Look at the M&A market. We've hit a near-record $4.5 trillion in deals this year. These mega deals are fueled by cheap debt. A Fed chair who promises lower rates is essentially giving a blank check to the giants of industry to continue their acquisition spree. From Netflix to the massive rail mergers, cheap money is the lifeblood of these transactions. This boom isn't just about size, it's about restructuring. With lower borrowing costs, companies can afford to take risks on AI and new technology. This is why the Big Six banks added $600 billion in market cap. They are the gatekeepers of this cheap capital. Under a Hassett Fed, the M&A supercycle could extend for years, creating massive winners in the financial and industrial sectors. For a century, the Federal Reserve's independence has been the anchor of the global financial system. But that anchor is dragging. If the market perceives the new chair as a political puppet, the risk premium on U.S. debt will soar. International investors will demand higher yields to hold treasury bonds, fearing that the Fed will print its way out of the national debt. This is the great irony. If the Fed lowers rates too aggressively for political reasons, long-term mortgage and business loan rates might actually rise because of inflation fears. This bond vigilante effect could paralyze the housing market. As an investor, you must watch the 10-year Treasury yield. It is the true measure of whether the market trusts the new Fed chair or fears them. So, how do you position yourself? In a world of aggressive rate cuts and rising inflation, cash is trash. You need assets that have pricing power. This means companies can raise their prices as their costs go up. Think of the giants in tech and healthcare. Additionally, hard assets like silver, with its 164% gain, act as a non-debasable insurance policy for your wealth. Diversification is no longer a suggestion, it is a survival requirement. Balance your high-growth AI stocks with commodities and perhaps a small allocation to crypto to capture the liquidity wave. Use the real rate formula to check your returns every month. If your return isn't beating inflation, you aren't growing. You are just staying still while the world moves past you. The succession of the Fed chair marks the birth of a new economic era. Whether it leads to a Hassett boom or a stagflation trap, the stakes have never been higher. The rules of the 2010s no longer apply. We are entering a period of high volatility, massive megadeals, and political influence over money itself. Your greatest asset isn't your money, it's your information. Stay ahead of the curve by monitoring the transition and understanding the formulas we've discussed. The earthquake has started, but with the right strategy, you can find solid ground. Subscribe now for more deep dive analyses on the future of your wealth. Let's master this new era together.